Hello and welcome to the Nedbank Private Wealth Investment and Wealth Insights Report. We're live from our studios here in London, and today we're going to be joined by expert guests from the worlds of politics, investment management, behavioural science and sports journalism. So if you have a question for any of our guests, please do use the box in your viewing panel and I will put them to our experts during the show. But let's see what we've got lined up for you today. Ned Group Investments Portfolio Manager Madhushree Agarwal will be giving us an overview of what's been influencing investment markets recently. And does it feel like we're bouncing from one global crisis to the next? Investment counsellor Rebecca Cretney will be talking about Permacrisis. Then journalist and author Simon Mundie shot a short video for us before he was whisked off to report on Wimbledon for the BBC, giving us his insight into what we can learn from top athletes such as Novak Djokovic and Jonny Wilkinson, and more importantly, how to avoid burnout. And then waiting in the wings to discuss those topics in more detail live are Nedbank Private Wealth Chief Investment Officer Tom Caddick and Head of Business Development Andrew Simpson and behavioural scientist Paul Craven. But first, I am delighted to be joined by former Government Special Advisor Joe Tetlow and accountant and political broadcaster Lars Swann, who are going to give us their insight on what the recent UK election could mean specifically for high net worth individuals. So welcome to the show. Thank you so much for coming along today. And yes, okay, so I suppose because of the polls, the outcome of the recent UK election wasn't entirely unexpected, was it? But today, let's look at that result from the perspective, as I just said, of the wealthier individuals. Do you think they should be worried?
Thanks, Jemma. In terms of being worried or not, I think let's wait and see. We're not going to have a budget or an autumn statement immediately. That's likely to be in the autumn, later this year. Labour have obviously set out in quite a lot of detail in their manifesto and the costings what to expect in terms of revenue raising. So everyone can see what's in there. I suppose some of the unanswered questions are, the kind of gaps that have been identified, what more might they do, and also on what timelines.
Yeah, because there's been some language that's been sort of probably purposefully ambiguous, yeah? So the next budget, you mentioned autumn as a timeline, so explain the thinking behind that.
So the Labour Party are going to involve the OBR and they do a review which takes about 10 weeks or so. Yeah. So Parliament's going to break up for recess at the end of July, and MPs will go away in August, and then they'll come back in September, there'll be conference season, and then so we can expect a budget, a fiscal event in October. That's what many commentators expect. And Rachel Reeves then, at that point, will set out what revenue raises and what spending the Labour government expects to do. And there'll also be a comprehensive spending review as well, because there was one 3 years ago in 2021 under Rishi Sunak, and Labour will now have the opportunity to set out their spending plans for the next 3 years. Okay,
now obviously there's always so much speculation from the newspapers, from commentators. What's your sort of personal view in terms of Labour's approach with wealthier individuals? Obviously, I know Starmer has purposefully put a lot of clear blue water between him and the last, between Jeremy Corbyn, for instance, but what do you think? And also, before the election, Patrick Diamond, who worked for Tony Blair and Gordon Brown, did say that they'd probably have to impose higher taxes on wealth if they won. But Starmer said the number one mission was wealth creation, so slightly different language there. What do you think?
Well, I think one of the key things that Rachel Reeves and Keir Starmer have been trying to do is to reassure businesses, to court businesses. They've also made growth central to their agenda, and already we've seen in the first week that they've done things like unblocking onshore wind, and they've tried to turbocharge
house building,
exactly. Yeah. So there are things there in terms of the growth agenda which people can see and can be energised by. In terms of taxation on wealth, obviously a few things have been set out already. For example, VAT on private schools. Yes. And stuff to do with the non-dom status. I think the key there is just let's wait and see what Labour come out and say in the autumn. There's quite a lot of political uncertainty at the moment around the world. I mean, you look at France, you look at the United States as well.
Gosh, yes.
So Labour having quite a big majority, I think it's 181 working majority in Parliament, there is an element of stability in terms of the new Labour government. So that is something to be mindful of when thinking about your own personal circumstances.
And also, I suppose, no matter what the result is, just having a new government is more, as you say, stable than constantly knowing that an election is coming up, when's that going to be, and all of that sort of turbulence. So obviously we had it a little bit earlier than expected. Okay, so to go to you now, Lars, because we've got an accountant on the sofa, so let's ask you about the tax implications. There has been a lot, as I said, in the press, but often that can be quite alarmist, can't it? It can be quite headline grabbing, and I think we want to be really sort of measured here. So what are you hearing?
So in terms of inheritance tax, you're looking at, I don't think they're going to make any changes to the rates, the allowance, the 325,000 inheritance tax allowance. I think what they will do is they will tighten up the offshore trusts to help with the anti-avoidance of moving your wealth across into offshore trusts to avoid inheritance tax. I also think on stamp duty for non-DOMs, they're going to increase stamp duty by between 2 and 3%, even as much as 4%. Additional stamp duty for those people buying properties in the UK who are non-DOM status. They've already indicated on corporation tax that that taxation they're not going to change. What they're not saying is that whether they're going to take the marginal rate from 19% straight to 25%, and I suspect that is what will happen. They'll keep the main rate at 25%, but they'll abolish the 19% and the marginal rate so that everyone's paying corporation tax at 25%.
Okay. So, and obviously we'll have that confirmed or denied when we get
the biggest
to the
thing,
budget.
of course, will be the VAT on school fees.
Yes.
And there's no real clear direction of travel on that as far as I can see.
They've been very certain about that. It feels like that would be very strange if they sort of backpedaled on that now. So we feel like people know that's going to happen. And the non-DOM status, as you've
and the non-DOM
said,
status, they're going to try and remove that. With the VAT is quite important because the VAT will only be, and once it's announced, it then becomes law. There is almost, I think, a slight loophole opportunity for people to prepay their school fees.
I think a lot of people have been doing that, absolutely. So, okay, so if there are people watching and they're going, oh, I've got some concerns about these changes, what would you recommend?
I mean, just to look at, in terms of capital gains tax, just to look at if they're planning on selling assets, whether they can sell them early, because you don't really know what's going to happen with CGT. There was a document that was being bandied around government about aligning capital gains tax with income tax at one point. That got abandoned. Whether they will try and bring that back or not, I don't know whether that's what they're possibly going to do. But look at assets that you've got and whether you can sell them early. If you think but it's a bit like the whole chicken and egg scenario. You don't know what they're going to do, but if they do it, it has a detrimental effect on you. So if you try and minimise that risk now by selling assets early, there is a potential for tax savings. The other thing, of course, is if you can, pay your school fees up front.
Yeah. There's a deal to be done, perhaps.
Yeah.
As you say. Well, I think that VAT, which was, I suppose, a tax break because of the charitable status, that is one thing that has been mooted for such a long time. So I think that is definitely a given.
You have to be quite clear, they're not getting rid of charitable status. What they're doing is they're changing the VAT Act to allow them to charge VAT on it, rather than removing charitable status for the schools itself.
Yeah, and it would be interesting to see whether schools might make some adjustments and not pass that on to parents as well. We'll have to wait and see.
I have spoken to a couple of private schools in the southeast who said they are going to try and minimise the impact on parents by making some cost savings in their own schools to try and minimise, because obviously the schools are going to be affected, because if they've got children leaving school, there's school fees they're not going to get.
The other key point in terms of when we're likely to see this come in is I think we've heard it's been briefed that it's going to be September 2025. Obviously, that's the start of a new school year. Parents and schools need time to plan.
Yeah.
I think in terms of other taxes, straight away after a budget, that can happen immediately. For example, you could levy VAT pretty much immediately. So, but I think for some changes, we might see more of a delay, so that it gives schools and parents time to plan.
Yeah. And with the first female chancellor. Interesting times. Just thought I'd chuck that in there. Right.
She's an economist as well.
Yeah, she's an economist, and that might help. So, okay, let's go to non-dom status. In your opinion, Lars, do you think, because again, I've seen some fairly dramatic headlines, and again, I kind of know how the press work, and I think there's always probably some truth in there, and then maybe there's some exaggeration as well. So would you say that everybody with money will now be moving abroad or moving their money overseas?
I don't. There's going to be an element of that that's going to happen.
Yeah.
Non-dom status has been a bit of a difficult scenario in the tax profession for a number of years, with the rules changing every 5 minutes. So it's very complicated, and some of the rules around resident status have been quite complex.
Yeah.
I don't think you're going to see a mass exodus of people leaving the country. Because of the tax regime, because they all still like their children to go to our schools and at our universities, so they're all going to have these ties. I don't see there being a mass exodus. It might be just slightly more expensive for them in the long run.
Yeah, and I guess also there's that sort of truth that they've got assets here, they've got homes here, they've got lives here, so it would be a big decision to totally up stick. So we'll have to see how that one pans out. Okay, so if the government do make these changes, which we think they absolutely will, on the non-dom status, you're saying that could happen as early as when the budget comes in.
Yeah, exactly. So there'll be a finance bill, which will be a finance act. That's legislation which Parliament has to pass. And some changes can happen immediately, at sort of midnight on the night of the budget. So let's wait and see what's in it. There will be probably some briefings beforehand about what Labour intend to put in that budget. Again, they're not going to want to spook the markets. So
yes.
I think people will get a bit of foresight in terms of what's going to be in there. And we already know the things that are in the manifesto. I think the big question is what's not in the manifesto that they might end up.
Whether the language has been very careful.
Exactly.
Yeah.
That sort of main vase strategy that the Labour Party have been adhering to throughout the election campaign.
Yeah. They've put the vase down now.
Yeah. Well, let's hope it doesn't shatter. But I mean, I think that's going to be the interesting thing that we see across the summer. We've already seen Rachel Reeves come out and say that the economic circumstances that she's inherited are worse than they expected. So that's laying a little bit of the political framing for some tax
to allow
rises
some,
in the autumn. But let's wait and see.
Okay.
I'd like to think that they did it all in the 5th of April rather than immediately, because it does cause problems for HMRC and them getting the systems up in place. Sure. So we always like to see when
accountants trying to catch up.
When they make a change, not just from an accountant's perspective, but when they made the change to the national insurance, all the payroll software companies were scrambling around trying to sort this out really quickly because it was going to come into place in a couple of months. I'd like to think that they use the tax year basis period for being able to make those changes.
That's a very good point. And I just wanted to quickly alight on it's very interesting what you say as well, because we have entered this culture now where almost they make announcements and you know what they're going to be. And there was a lot of leaking, right? So we'll see whether that stays or whether when they make an announcement, it's actually an announcement.
Yeah,
Sometimes you find yourself discussing the things that are going to be announced before they've happened.
Yeah. I mean, in politics, there's something called kite flying, where things do get briefed out to see how the public react to these things and whether politicians agree as well. So, I mean, in the week up to the budget, there will be lots of briefings about what's going to be in it so that the markets aren't spooked. They won't want a repeat of what happened with Liz Truss. They won't want any nasty surprises. They want to keep it very calm and very steady. And I think that's what we'll see. Also, another quick point is that they're only likely to be doing one fiscal event. They've already announced that. So it'll be an autumn budget and they'll try and keep to that annual fiscal event.
Okay, excellent. Well, look, thank you so much for joining me here in the studio today. It was really, really interesting. Thank you very much to both of you. Okay, now with all the media attention that it's been getting, you may be wondering whether politics has affected investment markets so far this year. And earlier this week, portfolio manager Madhushree Agarwal prepared a summary from the Nedbank private wealth offices in London, giving us her update on what's been impacting markets in 2024 so far.
Today, we're diving into the fascinating world of financial markets and the key themes that have shaped the first half of 2024. Despite the lingering effects of a global pandemic, the most aggressive monetary tightening cycle in decades, and escalating geopolitical tensions around the world, economies have remained resilient, defying widespread predictions of a recession. For over a year, investors have braced themselves for the worst, fearing that elevated interest rates would push economies into a downturn. Yet, this has not materialized. Instead, we've seen growth and stronger economic data emerge. Consumers in particular have displayed impressive resilience, supported by a tight labour market. Unemployment rates remain historically low, with the US staying at or below 4% since December 2022, marking the longest streak of low unemployment since the late 1960s. Job reports have also shown average hourly earnings rising more than economists had anticipated. These higher wages could feed into higher prices and ultimately higher inflation. Now, while we've seen inflation drop sharply over the past 2 years, this year inflation has been stickier. You can see progress has slowed in recent months. A strong economy and higher wages could continue to drive prices up. And that's leading many to question when central banks will begin cutting interest rates. Now, a significant trend we've seen this year has been the dramatic shift in market expectations for rate cuts. Here, we're focused on the US, given its status as the world's largest economy and a bellwether for global financial markets, influencing investor behaviors worldwide. Initially, at the beginning of the year, the market anticipated 6 rate cuts. However, with persistent inflation and better economic data, these expectations dwindled to none, before settling on the possibility of 1 cut by year's end. It's clear that the prospect of higher rates for longer is now firmly on the table. Investors have adjusted to this reality, leading to higher, longer-term interest rates. This shift has pressured bond prices, but has made them more attractively valued. Remember, as yields rise, bond prices fall because future cash flows are discounted at a higher rate. Now, though, the attractive income offered by fixed income investments provides a strong base for returns over the next 12 months. And this will be further enhanced by positive capital gains as yields come down. Equity markets, on the other hand, seem unfazed by higher interest rates, which typically squeeze profit margins as corporations find it more expensive to issue and refinance debt. They've remained resilient, continuing their upward momentum, with several major indices reaching all-time highs this year. Strong earnings growth, which has been better than expected, and positive forward guidance from management has fueled market confidence. And of course, the continued excitement surrounding artificial intelligence has significantly influenced market dynamics. Gains in equity markets has been concentrated among the largest mega-cap companies, particularly those related to tech and AI in the US, like Nvidia, Meta, Alphabet, and Microsoft. These companies have dominated market performance, leading overall valuations to appear quite stretched. However, there are pockets of opportunities outside this mega-cap universe. This chart shows just that. Here you can see how expensive different equity regions are relative to their own history and to each other. We've split the US into 2 areas: larger companies represented by the S&P 500 and smaller ones shown by the S&P 600. The S&P 500 is trading close to its historical highs and stands as the most expensive area relative to other regions. This is the impact of those few very popular companies we've seen in headlines a lot. Removing the impact of these larger companies, the S&P Small Cap Index reveals current valuations are actually quite attractive. Remember, valuations are crucial to your long-term returns. The lower price at which you buy, the more buffer you have, and the higher your overall long-term return is. So it's important to look beneath the surface and apply an active approach to identifying companies with quality earnings and attractive valuations. Other regions outside the US also show promise. For example, Europe has begun cutting rates. In June, the ECB delivered their first rate cut since 2019, which should support investment returns there. Many emerging market economies, particularly in Latin America, have also been successful in controlling their inflation and are now well underway in cutting their rates. These areas offer attractive high real yields, which is yields adjusted for inflation. They are also supported by various positive secular trends, such as semiconductor manufacturing related to AI, particularly in Thailand and South Korea. In Japan, on the other hand, we saw a significant milestone as the Bank of Japan ended its negative interest rate policy in March, raising their base rate for the first time in 17 years. This shows the strength of the region and, along with ongoing corporate reforms, should be supportive of businesses there. Clearly, there is a lot going on, and we are well equipped to take advantage of these exciting opportunities.
And I'm now joined by a familiar face on the show, Chief Investment Officer Tom Caddick. Hello, Tom. Nice to see you.
Hi,
now, that was very interesting from Madhushree there, but what are the key takeaways, would you say, from an investor perspective?
Well, I think from an investor perspective, as Madhushree was saying, we're talking, and we've talked about this before, but about inflation coming down sharply, but it's still relatively high and it's slightly sticky.
Yeah.
About the big conundrum of when we start to see base rates turn, so central banks start to move into a more accommodative environment. So we start to see those rates coming down. And a big takeaway there is that there are opportunities out there. It's easy to just look at the headlines and look at stretched valuations in certain areas and think that we are in a certain type of environment, but actually there are some really good investment opportunities.
Oh, well, that's good to hear. And so on that note, what does it all really mean for sort of your average investor? So by which I mean someone who is investing, but perhaps doesn't want to be in the weeds and all of the real finer detail.
I mean, I think the key takeaways here is that actually it's a reasonably good time to be invested.
Okay.
I mean, our advice would always be you remain invested, you stay invested, and that'll help you through the course of the different cycles. But actually, it is a reasonably good environment at the moment.
Okay. Now, Madhushree mentioned AI-related companies. They've obviously been soaring for a while. I saw one of Gareth Southgate the other day. It was quite frightening. It wasn't him, obviously, but it was very funny. But that aside, do you think the bubble will burst?
So you've called it a bubble, which therefore suggests that
yeah.
it is indeed a bubble. Now, when you see soaring prices, clearly, and we're talking mostly in the US, there's something quite often called the Magnificent Seven. We've spoken about it before. But when you're seeing soaring prices, there has to be something to justify that. So the likes of Nvidia, which from time to time seems to become the world's biggest company and has come from almost nowhere, what they are seeing is revenue growth.
Okay.
So they're seeing profits soar. Okay. So to be able to justify those climbing valuations, you have to have the profit or the revenue and the growth behind it to justify it.
Okay.
Things do look quite stretched in those areas, but Nvidia, as one example, has continued to come in ahead of expectation.
Yeah.
So it's almost been justifying it, but certainly they do look quite stretched.
Yeah. My problem with AI is that I don't understand it. Leave it to the experts. So from an investment perspective, it would appear that the first half of the year hasn't quite turned out as we expected. So what does that mean for the second half, and what would you expect?
So if I was at school, if I was giving myself a score, I'd probably give myself 6 out of 10 on that one.
All right, decent.
Right ideas, wrong time.
Okay.
And I think what we've seen so far is we are still in that environment. And you said what about the second half? We are anticipating really a lot of those thoughts around a pivot with central banks. So we're starting to see a fall in interest rates being pushed into the second half. We have seen inflation come under control. It remains slightly sticky, but we're starting to get some more positive news coming through.
Yeah.
Economies look reasonably robust, particularly in Western markets, so the US, large swathes of Europe look actually fairly robust. So our big worry before was the potential for recession. And we've had a very brief technical
It sort of
recession.
went in for sort
Absolutely,
of
yeah.
a day or something.
Yeah.
Yeah.
But actually, we're starting to see growth come back in. US has remained fairly robust. So a lot of the things that we were maybe anticipating earlier in the year really are being pushed into the second half.
Okay. Of course, we've got the big election coming up in the States as well. So let's get the crystal ball out. What kind of things are you keeping an eye on? What do you think might be a growth area in the second half of the year and then into 2025?
Yeah. So a number of different areas. We've talked about fixed income before. So these are sort of things like the bond market, so gilts, as well as buying corporate debt. These are things that give you a yield. They pay out interest. We do like that area of the market.
Yeah.
Because, as Madhushree was saying just now, you have that sort of imbalance between falling interest rates, rising values.
Okay.
So that's what you get from that market, as opposed to cash, where falling interest rates just means you get less money coming in for your cash.
Right, got
so
it.
we do like fixed income. We do increasingly like equities, but very selectively so. So areas that we've been adding into portfolios recently have been US mid and small companies. They give us exposure to the local, the more domestic economy. They do look like they're pretty well valued, as opposed to the large cap, the larger companies. So we do like those sorts of areas within portfolios, and actually increasingly like what we would describe as more cyclical stocks, things that will do well as economies start to turn.
Okay.
So we start to see things strengthen in the economy as we anticipate, those areas that will do well.
Most things are cyclical, aren't they?
Absolutely.
Ultimately. So finally, if I'm not investing yet, but I was thinking about entering the investment market, what should I be thinking about, and when would be a good time to go for it?
So there are all sorts of cliches that one could use, like timing, not time in. So you want to be in the market, not trying to time the market. And almost all evidence historically would say you stay in the market, and the longer you're in the market, the more that time value helps you mitigate against some of those risks that you see. But I know that that doesn't necessarily always help someone who's just there and actually a little bit nervous. The fact of the matter is, if you're just sitting in cash, if we start to see interest rates fall, what you're going to get from your cash diminishes, so that starts to fall away. It doesn't mean that the value of the cash itself has fallen, but your interest rates will fall. Now, the flip side of that is that on those other things that you could have been invested in, like fixed income, in many equity markets as well, will do very well in a falling interest rate environment. So if you wait on the sidelines in cash, you've got a falling interest rate return, and you maybe have missed out on the opportunity that
your money's not
itself.
working for
It's
you.
not working for you, and you've missed that opportunity. So general rule of thumb is you get involved, you get invested, and you stay invested.
Get stuck in. Good advice. Okay, thank you so much. Now, it does feel like we're moving, I'm afraid, from one global crisis to the next and constantly having to adapt to change. So I'm now going to hand over to investment counsellor Rebecca Cretney, who recorded a short video for us, filmed on location at the Nunnery in the Isle of Man, and looking at Permacrisis.
Permacrisis, or permanent crisis, was the Oxford Dictionary's word of the year in 2022. It encapsulates that long-lasting feeling of instability and insecurity that we've been living through. COVID, conflicts, inflation, elections, all accompanied by alarming headlines that overwhelm our time and emotions and cloud our decision-making. Good news never did sell well. We humans are typically risk-averse. The more negative news we read, the more cautious we are likely to be, especially with our finances. We are hardwired to feel the loss. It affects the primitive part of our brain that tells us to flee. So, when we are living through a period of turmoil, the temptation is to do something, anything to make it stop. But sometimes the best thing to do is nothing. And nothing is exactly what we asked you, our clients, to do some 2 years ago. When Russia invaded the Ukraine, inflation spiked and interest rates began the sharpest rise we've seen in generations. dramatically shifting the price of any income-yielding asset. We asked you to remain invested, and now you're starting to reap the rewards. You see, the latest turmoil had a particularly devastating effect on lower-risk assets, investments that pay a high yield, which are typically considered lower risk. These dropped as much as higher-risk assets, such as equities. We knew there was no question surrounding the quality of the assets in your portfolio, that the reversal was just a matter of time, and that crises are just an opportunity in disguise, which can bring substantial rewards. Last year, we saw the first reversal. One of our music funds increased 67%, practically overnight. Then, a second music fund, Hypnosis, did the same some months later, increasing by 48% overnight. Now, 2 more investments have turned the corner. GCP has returned 44% year to date, and Foresight, which is in our sustainable portfolios, has returned 57% year to date. But the opportunity does not end with these good news stories. There is still significant pent-up value in our investments, through our bond exposure and through our real assets. This is a time of opportunity to add to portfolios in the knowledge that calm calculation leads to reward. The best time to buy are periods of uncertainty, when everyone else is selling. Crises aren't a new occurrence. They have been happening for as long as trade existed, and well before we had such easy access to live news updates. Markets adapt, they recover. So how do we at Nedbank Private Wealth keep our cool in turmoil? Discipline. We focus on 4 significant pillars: economic fundamentals, valuation, sentiment, and external market influences, geopolitics. If you're influenced only by economics or geopolitics, this can lead to buying high and selling low. If you're only influenced by valuations, this would mean you would put a significant portion of your assets in countries such as Russia or Argentina. Patience is indeed a virtue. Now, your calm calculation is reaping its reward.
I have to say, it does feel like every time I look at the news, there is always going to be some new crisis on the horizon to worry about. And then if you want to get away from the doom and gloom and avoid the news, it's still always there when you pick up your phone in one way or another. So to look at this in a bit more detail, Tom and I are now joined on the sofa by behavioural scientist Paul Craven. So lovely to see you, Paul. Now, as well as being a behavioural scientist and a founder member of the Cialdini Institute, you have over 30 years of experience of working in the asset management industry. So therefore, I'm guessing a very unique perspective on the sort of combination of human behaviours, but within permacrisis instability, which I feel like I suffer from on a daily basis, just within myself, and also investing. So how is being on this constant sort of treadmill of instability and change affecting us as humans? Because we can't get away from it, can we really?
Yes, you're right. I've had 30 years both as an asset manager, and then I'm now on the investment committees of some institutional pension schemes. And my interest in behavioural science is really, well, how do real people make real decisions in the real world? That's what behavioural science is trying to do. And clearly one can talk about valuations and all those important things in a market or a stock. What we're trying to do from a behavioural angle is to look at the human side behind it, the emotions, the biases, what drives the way we behave. So certain biases like the herd instinct, hindsight bias, etc. And we look at the long-term market cycles amidst the long-term trend, which we hope goes from bottom left to top right, which it does tend to do when one looks at most capitalist systems. And the question is one of time. So clearly one of the things we're looking at is when there's a crisis, what can you do about it? You mentioned permacrisis. We're still getting our economic cycles, and the market's still doing pretty well recently. So,
Yeah.
but we're trying to add the analysis of human decision-making process.
So that's very interesting. So in other words, as much as we would like to think that all our economic or business decisions are grounded in rationality and logic, at times they simply aren't because we're human.
That's right. Richard Thaler came up with the concept of homo economicus, as if we're always rational, analytical, data-driven.
Totally together.
Exactly. Whereas I think we all know that we're not quite like that. We'd like to be like that.
Yeah.
And the trouble is with a lot of classical economic models is they say we're like that, homo economicus, but we're not.
Yeah. Okay.
And so it's how do we account for that sort of feelings and behaviours in our investment style, and indeed in life generally.
Yeah, so how do those human feelings and behaviours and moods and so on impact decision making and perhaps perception of risk as well when it comes to investing?
Yeah, I think when you look at the human mind, it's a bit like a sort of roller coaster. And in fact, there's a slide that I always liked about the emotional cycle rather than the economic or the market cycle. And the idea being that actually as your investments you're in start to go up, you start to feel optimistic, excited, and indeed you're getting pretty euphoric. Now history tells us that when most people are the most excited and thrilled and happy, that's the most dangerous time in markets generally. It's the point of maximum risk. Yeah.
When you're going to be a bit sort of carefree, I'm going to go for it.
Correct. And what it tends to mean is you run out of buyers. And then what happens is the market starts to turn over, and we then start to get, as the markets start to fall, you actually get the emotions changing. So we start to get anxiety, denial, fear, etc. And investors start to question themselves. They start to say, well, it's okay, I'm a long-term investor, I'll be fine. But markets keep on going down. And then we get the famous sort of panic and capitulation phase. And this has happened a few times in certain recent lifetime, 2002, 2003, 2008, 2009, COVID, 2020. And at the bottom of markets, most people are depressed and there are no more sellers because everyone's sold near the bottom.
Yeah.
And that's obviously the time that the skilled fund managers, if you like, are looking to buy. Whilst it feels bad for everyone, that's the time when the most opportunities are. And that happens time and time and time again.
Yeah. Wow, I find that really, really interesting.
So Buffett gives us an example. I mean, Buffett says, and I know we always quote Buffett, but he does say some extraordinarily wise things. Be fearful when others are greedy, and greedy when others are fearful. Now, that's easy to say.
Yeah.
It's hard to do.
I bet. So, Tom, can this sort of more cautious nature, perhaps when the markets are levelled out, can that be seen in the way people invest in your experience?
So, I think it's a fascinating subject because, as Paul says, all of our graduates coming in, they've been taught that markets are utterly efficient and will behave themselves.
Yeah.
And as Paul described there, is actually shorter term is anything but. And the paradox is that to a certain extent, we need to understand that, but at the same time, you still want it because it creates opportunity, which is exactly what Paul's just talking about there, which is, that sort of the Buffett effect of trying to almost sort of do the opposite at times when you get those extremes in markets.
Okay.
For us, this really sort of sums up why we would have a robust investment process to try to avoid the noise.
Yeah.
That permacrisis that Rebecca was talking about just now, to be able to look through that and be able to take a longer term view.
Okay. So better in the long term to think about maximising wins or limiting losses?
When I started in the city in 1986, there was an old director there called Keith Nevin, who dumped a seven-page piece of research on my desk and said, read this. And I've never forgotten it, and I refer to it a lot. And it's by a gentleman called Charles Ellis, and it's called Winning the Loser's Game. And he's written a book about it subsequently, although the original 7-page article is brilliant, and you can find it online for free. And what Ellis looked at all the investors he could find up to that point. In fact, it was written in 1975, so this is actually from the sort of dark ages almost, but the data still stands. And he said that investment in aggregate for the whole marketplace is a loser's game. Okay. In other words, on average, most people don't do very well. Now, my experience tells me that actually there's plenty of good, skillful investors out there whom one wants to take advantage with. And Ellis's secret was, he called it, how do you win a game that most people lose? How do you win the loser's game? And he looked at the military. He looked at tennis, actually, interestingly, how people win games of tennis, and various. He looks at aviation, and just to give you a couple of, let's take the tennis example. If you look at most people playing tennis, and this certainly applies to all amateurs, and indeed it actually applies pretty well to the professional game as well, most points are actually won by the opponent making a mistake. In other words, hitting the ball out, what's called an unforced error in tennis.
Yeah.
And Ellis's point is, if you look at the example of tennis, you want to get the ball back.
Yeah.
He then takes it into the world of investment, and I think he does that fairly justifiably and says, you want to be around to enjoy the long term. Don't risk it all in the short term. Don't try and smash the ball or hit it really hard. Get the ball back. And all the data he analysed, which I say was up to 75 at the time, but now it's been updated and it works to the present day, stay in the game. You don't have to be the best every year. If you stay around, you'll start moving up the quartile rankings because your opponents, other investors, will start to try and smash the ball, and they'll start making mistakes, and they'll get it wrong.
I like that.
And it's a brilliant long-term metaphor. And then just on the aviation thing, I mean, it sounds a truism, but it's so obvious. But we don't actually want, when we go away on holiday, the best pilot in the world. We want the safest pilot in the world. There's a big difference.
You're right.
Well, I want someone that's going to get me from A to B.
Yeah.
And there's a quote from, this isn't in Ellis's paper or book, but there's a quote from 1959 from a pilot who said there were old pilots and there are bold pilots, but there were no old, bold pilots. Now, there are old investors and there are bold investors. There aren't many old, bold investors.
Got it.
That's simple advice, but I think it's pretty good. And it's as good as the day that Ellis wrote winning the losers game in 1975.
Yeah, I think that sounds like very good advice. So good way of thinking about it. And so you shouldn't be put off. You should wait things out rather than sometimes pull the plug and then sit in cash, Tom. It's kind of what we were talking about before.
It's exactly what we were talking about before. And, I think that's where emotion, as Paul's described, that sort of the roller coaster, can work so badly against you.
Yeah.
Which is making emotional decisions that quite often are just the
Panicking.
wrong time.
Yeah.
Absolutely.
Okay. Do you think there's more instability and crisis these days around the world, or is it just the fact that we're in this digital age and therefore it's there, and so therefore we're absorbing all this information?
I think it's the latter.
Yeah.
As much as anything. It's the fact that you saw it and you didn't have to wait, a week for it to be sort of page 3 in a newspaper.
Yeah.
You're getting it now, and the media has time to fill.
Yeah.
So they will put it in front of you 24/7.
Absolutely. Well, thank you so much. This is now going to lead us on to the next section, and it'll lead us on very nicely as well. This is Simon Mundie. He's a BBC journalist and author, and he's written a book called Champion Thinking, which is based on his countless conversations with top sports stars. So how can we take inspiration from them to achieve peak performance and, importantly, avoid burnout when we are bombarded by noise 24/7?
I'm going to start by referencing a study that came out of Harvard in the 1950s, which found that our conscious attention, our conscious awareness, can only handle 5 pieces of information at any one time, plus or minus 2. So 7 at the top end, 3 at the bottom. Now, this was in the 50s. Clearly, we are more distracted now, so we're focusing on burnout and flow. If you experience the symptoms of burnout, you're less able to get in flow when you feel and perform at your best. But if you can get in flow, that can be preventative against the symptoms of burnout. There's no doubt that burnout is a big and growing problem. The charity Mental Health UK released a report that found that 1 in 5 adults took time off from work because of mental health and stress last year. So the question is, how can we get our minds off the treadmill? Well, one way to think about it is like a computer. What do you do when your computer stops working? Switch it off and switch it on again. And we need to be doing the same thing with our brains. Now, so many people extol the virtues of, for example, yoga and meditation, but they're not for everyone. So another thing to consider is active relaxation. It's about finding an activity that you enjoy for its own sake, that engages your brain in such a way that you stop ruminating about the past or worrying about your to-do list in the future. It's literally about finding something that you enjoy for its own sake, that engages you, that allows your brain to power down. Now, there's something else that we can consider which is a bit more immediate when we feel the signs of burnout coming on, when we feel the signs of stress, and that's to come into our senses. There's a really powerful protocol that you can do at any time, 5, 4, 3, 2, 1 protocol. Notice 5 things that you can see, 4 things that you can hear, 3 things that you can feel, 2 things that you can taste, 1 thing that you can smell. Now, what we want to do is take our attention to the sensation or the perception itself. What can we see without mentally labeling what we see? Right now, I can feel the sensation of my feet on the floor or the wind on my face. And the more that you're able to come directly to the sensation and perception, that draws energy away from your thinking mind, which slows the thought stream down. So it's a way to be mindful, to be present, and to stop the excessive rumination that so many of us are subject to. Now, the third thing to consider is arguably the most important, because for the first time in human history, we don't have to be bored. And why is that? Because we've got these high-powered computers within arm's reach. So what I'm saying here is we really need to start embracing boredom. Rather than reaching for our phones, we are switching the computer off, which means the less chance we have of becoming one of those burnout statistics. Now, flow is a state in which we feel and perform at our best. And the McKinsey Institute did some interesting research with top executives that found that when they were in flow, they could be up to 500% more productive, which theoretically means you could spend Monday in flow and have Tuesday through Friday off. So the question is, how do we get in flow? And when we're in flow, by the way, we are hit with an absolute deluge of happy hormones, of serotonin and dopamine and all things like that. So how do we get in that state? Now, there's a really interesting organization called the Flow Research Collective. And what they did is identify a 4-stage process to be able to give yourself a better chance of getting in flow. And it goes like this. Stage 1 is the struggle phase. Stage 2 is the release phase. Stage 3 is flow. Stage 4 is recover. So first is the struggle phase. You want to be working on one activity for an extended period and getting to that point where you have an itch, you have that urge to distract. You might feel a bit stressed, a bit tense, a bit anxious even. But rather than reaching for the distraction, we stay with that sense of an urge to distract ourselves. Step 2 is about releasing, because during that struggle phase, we've built up the stress hormones. And a good way to release is by doing some low-grade exercise. Go for a walk, go for a swim, which releases the stress hormones, and our unconscious mind, which has got so much more bandwidth than our conscious attention and awareness, is able to work on the problem that we've been working on. So that when we come back to it in stage 3, we are able to slip into flow if we can be focused on it for an extended period. And that's when the creativity will just spill out of us. And then stage 4, it's about recovery. We need to allow ourselves to power back down. If you can get into flow, success becomes all the more likely. So how do we do that? Well, perhaps we can consider reducing the email load. Can we reduce the meeting load? But also, can we develop our powers of focus, developing our powers of stretching the attention so that we can be happy and content in ourselves and also more productive at work and more safe from the dangers of burnout.
Okay, I'm now joined by Andy Simpson from Nedbank Private Wealth, and Paul is still with us as well. And that was very interesting. So I don't know, are you at home or in the office? Perhaps we all need to be closing our eyes, feeling our seat, feeling the floor. I mean, personally, it's just made me feel bad because this is the kind of thing that I need to do more of. Can you identify with what Simon was saying there? I know that, you know, even when you're out for a meal sometimes and perhaps waiting for other people to arrive, out comes the phone for a quick scroll. Oh, it's become such a sort of dreadful habit, really, when I could be soaking in the atmosphere, or like Simon said, embracing the boredom. And I think, you know, it's all very well, I'm always talking about sort of about young people on their phone. I think middle-aged people are the worst. Yeah, perhaps worse, I don't know. So all very interesting indeed. Could you identify with what Simon was saying there?
Yeah, 100%.
Yeah.
I'm always catching myself reaching for my phone when there's absolutely no need at all. It is just filling a period when I'm not entertained.
Yeah, absolutely. And we're going to also put a full version of that video up on the Nedbank Private Wealth website, so we can include a link for you as well in the email that we will then send out to everybody watching live. But Simon mentioned within the report that a recent report suggests 50% of people, I mean, that's a lot, obviously, suffering from burnout. I think that's quite an alarming stat, actually. But Andy, you work with a lot of very busy lawyers and advisors. So very high pressure jobs basically, do you think they get the opportunity to switch off enough? Is the culture there within the business?
Well, first of all, 50% is staggering. Obviously, that's clearly an issue, right? And I don't mean to pick on lawyers, but it's I've worked within that sector or alongside that sector for a long time, and it's been well documented that burnout is a problem within the legal world and also, like you say, any high pressure job. I think it's not a case of do they get the opportunity, they've got to make the opportunity.
Yeah.
You can't rely on someone else to be given it. You've got to go and you've got to take that opportunity, because if you don't switch off, if you don't unplug, whatever, it can be really simple. You're just making life very hard for yourself.
But maybe we do need to catch up a bit culturally. I know in Japan they have little sleep pods in some very big sort of tech businesses, for instance, where they encourage you to go and have 30 minutes to switch off. I mean, I'd be in favour of that. But yes, as you say, easier said than done when we've all got a stack of emails, very busy schedules and so on. But what are perhaps the first signs that somebody might be about to reach that burnout point, would you say?
I don't think either Paul or I are necessarily the right people to talk about in a huge amount of depth. But I think let's look at it from a different angle. So rather than waiting until someone's experiencing burnout, and there's a range of different levels of burnout and a range of symptoms, let's look at what we can do to reduce the chances of it.
Yeah.
And essentially, if you're permanently distracted, if you're switching from task to task, you're not efficient. You're making life really hard for yourself. And I don't think we're necessarily doing any more than we ever did. It just feels like it. So I would say, rather than looking at burnout, how can you look at ways to create an environment where you are efficient?
Yeah. It's like putting little rules in place and sort of no phone after, or this, that, the other, or limiting your screen time. And
yeah, I mean, I've spoken to Simon before. He's got a lockbox where he puts all his digital stuff in for a couple of hours if he needs to be creative.
Yeah,
that
I know.
sort of thing.
It's so true. My brain, when it rests on holiday, suddenly you get all your best ideas sometimes, isn't it? Because you've actually rested the brain.
Yeah, and flow is quite a new term for me, probably for a lot of people. It feels a little bit out there sometimes.
Yeah.
I'm trying to personally create something that's just a stepping stone to flow.
Okay.
Because it feels like maybe a bridge too far sometimes for me, conceptually, to achieve. But that is just cutting out distractions. And my first experience of how effective that can be, and Simon talks about the fact that they did a study on how executives can increase their efficiency by 500%.
Wow.
Right, so I haven't done that, but during COVID, when all the kids weren't at school, and my other half and I had full-time jobs, so we couldn't do that normal 8 hours. I wasn't sleeping, as a lot of people didn't. I would wake up at 4 or 5 and start working. And in that period, from until 9 a.m., I would get a day's work done.
Yeah.
Because I wasn't
Focused,
distracted, and it just goes back to that. I mean, it's a sort of a level of flow, I would say. So.
Okay, so let's talk a little bit more in depth with you about flow. Because it's really, really interesting. So how do you think we best get into this flow state? I think you might have a slide for us or something.
Yeah, well, I've got a little experiment. We'll put a slide up now, but let me explain it before we set the slide off. I'm obviously very interested as someone interested in behavioural science and how the human mind does and doesn't work. And one of the things you find is your mind plays tricks. But the flip side of this idea, your mind plays tricks, is actually the smallest cues can change the narrative. And so when we start to talk about flow, what are the cues that we can get into flow? So
flow being a calm state.
Yes, and basically effortlessly being able to do stuff and enjoying it, and almost time, you don't have a sense of time, and you start to really almost just sort of feel you're part of the thing. So sports people get it quite a lot as well, I mean, when they're playing well. But from a work point of view, so let me just try this experiment with the slide. Before the slide starts going, let me tell you what's going to happen. There, you should be able to see 2 cubes on the slide, and they're stationary at the moment. Now, in a second, and not yet, they will start to move. But actually, they never move at all. All they do is flash on and off. They flash on and off. And your mind will simply think they're moving because of what's happening to the arrows in the middle. So let's set it off now and see what you think the cubes are doing.
Oh, yes, it does look like they're moving. How bizarre. So that's my brain sort of playing tricks.
This is my favourite one now.
Ooh, that is moving, isn't it? No?
All they're doing is flashing on and off.
Ooh.
And this is, for me, an example of the power of the human mind. And the smallest, as I say, the smallest cues are changing the narrative. Now, I think this has relevance to what we're talking about, because if one is trying to get into flow, if you like, one is trying to change one's behaviours, one's trying to behave one's attitude, change one's attitudes, to say the permacrisis.
Yeah.
There are definitely things you can do. So you mentioned things like sleep. Clearly, that's very important. Refreshing, regenerating the brain. We know about diet and exercise. These are all really good things, and people know this whether they do them or not. It's another matter. Regular breaks. There's a very interesting psychological experiment done by an Italian psychologist in the 80s called the Pomodoro experiment. He was Italian.
Yeah.
And tomato. And you know why? Because he had a tomato timer. And he worked out that 25 to 30 minutes of hard work is absolutely fine. Then you should take a break, 5 to 10 minutes, and then go back to it. Now, again, this sounds like a sort of trivial thing, but it works. The science proves this kind of thing helps you with your creativity, helps you with your flow. And not to be underestimated, these little psychological tips and tricks that you can do to get into flow.
Interesting. And sort of, do you think we all have varying degrees of resilience, or is resilience something that you can work on to combat sort of our everyday life and be sort of strong, to be able to go, right, I'm going to do this now, I'm going to put that away? Because I think everyone can get a bit overwhelmed sometimes.
It's not just about sort of resilience in the sort of the macho sense of the word, it's about a mental awareness that there's good and bad. There will always be tough times in your life, and indeed part of any sort of the psychological studies into things like happiness and satisfaction, be not just you must go and search for unhappiness, but you must embrace challenges when they come. Sometimes if you can treat them like a game, that can be a very helpful way of doing it. I'm always reminded of the story about resilience, and this kind of ties into the talk about investment, actually. There's a story that sometimes is attributed to Mark Twain, which I rather like. He was...
all the best quotes.
Yeah, all the best quotes, but I don't think he had anything to do with the story. But anyway, and it links in with the investment bit, but it actually links in with this bit, which is the idea of play the longer game, which obviously resilience is part of. And the story goes that he was travelling in the Midwest somewhere, and he came across into a small town, and he saw some sort of gang of boys bullying a little boy. And he sort of went in and stepped in. Well, what's wrong? Why are you laughing at this kid? Why are you sort of mocking him? And they said, Mister, he played. Watch this game we play with him. And the sort of leader of the bullies held up 2 coins, and one was a valuable coin, and one was a not valuable coin. And they said, watch this, Mister. Watch how stupid he is. And then they turned to the little boy and said, which one do you want? And the little boy looked at them and said, I want this one here.
Okay.
And they all laughed because it was the less value coin. And they ran off. And Twain, or whoever came up with the story, said to the little boy after they'd gone, he said, they're a bit silly there. They offer you a choice of it was a nickel or a dime in actual fact. And you took the least expensive one. Why do you do that? And the little boy wiped away his tears and said, but mister, if I didn't take the little one, they wouldn't play that game with me every day.
Okay.
So there's resilience, there's investing for the long term, albeit in a slightly unethical, but it's making a serious point here. Stick around. It goes back to this winning the losers game argument.
Yeah.
You stick around, be there for tomorrow.
So that's a future entrepreneur right there.
Definitely, and it shows resilience as well.
Yeah,
and I think it's quite a useful little story.
Very nice indeed. Right, wonderful. Well, I've really enjoyed our chat. Unless there's anything else that you would like to end with, I think that's probably it. So I'm afraid that's all we've got time for today. But thank you so much to our wonderful guests, and of course to you for watching. And we'll see you next time on the Nedbank Private Wealth Investment and Wealth Insights Report. Take care.